Good morning, traders and investors. Roger Scott here, still the senior strategist for The Trading Pub. I don't know, I got used to saying that in the morning. Good morning, and I hope everybody had a nice weekend. This whole daylight saving time business is really getting to me. Woke up an hour earlier today, couldn't sleep, went to sleep earlier yesterday, have a headache. Ay, ay, vey. Don't get me started. But we're here, and it's Monday. Boy, oh boy, what a week last week. Talk about a turnaround in the SPY, right? Big turnaround. Now, before we get into today's session, I want to point out something to you. And by the way, I just want to point this out. I got a couple of emails on Friday saying, Roger, why didn't you tell me the market was going to turn around and go up? You weren't prepared. You were still giving out shorts in the VIP room. I got all those shorts and they all turned against me. Well, the Friday, not last Friday, but the Friday before last, I sent you guys, it was my last telegram of the week on Friday. And I sent an email with a telegram showing you that we were right here and saying that there's a really good odds we're going to go back to the upper end of the channel. Do you remember that? So I always give you shorts and longs in the VIP room. I don't tell you which ones to take. It's a learning exercise. I do it so that you guys could figure out, based on my analysis, how many you should do, which sector you should be in. These videos in the VIP room should be your guide. You shouldn't be blindly taking 5 shorts if I'm giving you 5 shorts or 10 shorts, because there's always a reason to have a short. You can have a hedge for a position. You can balance yourself out. There are still some shorts making money even if the market's going to go to a 52-week high. But the point is, pay attention to the overlying, the big picture, if you will, because what do I always tell you? Stocks are moving in response to the market about 70% of the time. So if we bottomed out here, and if we just went up here, if we just bottomed out here, there's a good odds we were going to go higher, and we did. So don't say I didn't warn you, because I could send you that telegram alert last showing you that I showed you on Friday, the Friday before last, we were right here. And I said, there's a good chance this channel will continue building. I dare anybody to say that I didn't. Anyway, very important. Don't just blindly follow my VIP trades. You know, you have to use some market dimension in there as well. All right. Now, this week we got plenty to talk about, and I hope you pay attention, and I hope you take notes, and I hope you do realize we're now at the upper end of this channel, and we have a very strong resistance here, and I'll talk about that in a bit. Now, the market's opening up a little bit higher, about 15 points on the Dow, 30 points on the Nasdaq. This is very random trading action. Mondays are usually hot and heavy. Markets are typically starting out nice and bullish. We'll see how it unfolds. As far as earnings, we don't have large caps coming out of the wazoo like we did last week. So all I did was just give you the biggest ones. Instead of giving you like 5 sheets of earnings that you won't use, I just gave you the biggest ones this week and their implied volatility. I figured this way you would be able to see where the action is. So you could see today it's just but look at Tuesday. OXY, Devon, Moss. We're moving out of tech now. We still have eBay, but we're moving out of tech and we're moving into Disney on Wednesday. That's going to be big. Guild on Tuesday. OXY, Devon, lots of energy stocks to pay attention to. And again, this is where the money is this week. You got MGM. It'll be interesting in light of China coming off. You got Trade Desk on Friday. But I'm going to telegram this to you, and you will get this via email a little bit later today. Now, as far as Fed data is concerned, all right, we've got FOMC meeting begins. Going to get a little bit of a, actually, hold on a second. Hold on. This is last week's. I'm thinking something is not right here. Okay, we're not going to get FOMC meeting begins. We've got international trades and goods and services. I was like, wait a minute, this is Groundhog Day. Yeah, you've got international trade in goods and services tomorrow. You've got Fed speakers, Williams and Logan speaking, and they're going to be saying, well, we'll talk about that in a minute, but they're basically going to be saying we're in a wait and see territory, and they are right, actually, right now. Williams is speaking on Wednesday. You've got petroleum status report. I want to talk about energies in just a bit. You got Bostic sprinkled, Fed speakers sprinkled in the entire week. But as far as Fed data is concerned, you've got jobless claims, you've got consumer sentiment, you've got wholesale inventories, and international trades and goods and services. Earnings are not going to be in focus as much as they were last week, and now we're going to be paying more attention to the Fed and global economy and policy. So just wanted to give you a heads up on that. Let's talk a little bit about what we can expect and go through everything, and then I'll get into some technical levels with you and give you the up and the down. And I hope to God you pay attention to what I say and stop having selective memory and hearing. Corporate earnings report and Federal Reserve Jerome Powell is going to speak later this week. Oy vey times 2. U.S. Labor Department report on Friday showed U.S. economy added only 150,000 jobs versus 180, and unemployment rate ticked up to a 1.75 year high. That's significant. Remember, employment is one of the biggest factors the Fed is looking at when they're regulating interest rates. That's very, very important. And remember, if there's less job openings, that means employers, not employees, are in control. And if employers are in control, that's not inflationary, because if you have too many jobs, employees can say, I want this much for hourly wage. I want this one. There's too many employees. Now there's not enough. So employers can tap down how much they're paying, which is better and less inflationary. I just want you to explain to you the scenario that we have. We have U.S. unemployment rate, ISM service index dropping to a 5-month low, 51.8, weaker than the expectation. You got Neil Kashkari stating on Friday that while hiring slowdown is seen as a positive news for central banks, it obviously is, it's not inflationary. He doesn't want to overreact to the data from just 1 month. Folks, the bond market is doing all of their work for them. They have to do nothing. They can just sit back and say, we're gonna wait. If anything, we'll see maybe a raise in January. We're not going to see any more raises this year, which may lead us to a bull rally towards the end of the year. And we're in a bullish market cycle right now as far as seasonality is concerned. Fed President Barkin had similar thoughts on the recent job data, indicating that his decision on whether to raise rates further will be more influenced by inflation reports. There is currently a less than 10% chance that they're going to do anything this year and a 16% chance that they're going to do something in January. Those numbers are coming off too. We'll see how that goes. But so far, there's not a lot of pressure from the Fed. This week, we've got earnings on Walt Disney, Gilead Science, Uber, eBay, Warner Brothers Discovery. Federal Chairman Jerome Powell will speak, and Christine Lagarde will speak as well. Export imports, trade balance, crude oil inventories on Wednesday, initial jobless claim, and consumer sentiment on Friday. Those are the big reports. We don't have huge reports, but crude oil inventories and U.S. exports and imports will be interesting. Crude oil rose as South Arabia and Russia reaffirmed their commitment to maintaining production cuts till the end of the year to squeeze as much money out of us as possible. Europe, down just a little bit, not getting any tailwind. Investors digested important data on regional business activity. Losses in real estate stock are leading the market lower. We'll have to pay attention to that because here they've been going up. China closed higher, tailwind from China, driven by optimism that major central banks are done with the interest rate hikes, while investors also geared up for upcoming economic reading from the country. Chinese top leaders have pledged to restore confidence in the stock market. Yeah, don't hold your breath, okay? Don't hold your breath. Japan closed sharply higher and hit a 1-month high. Good. Tracking Friday's Wall Street rally. Good. After weaker than expected U.S. payroll data boosted hopes that the Federal Reserve was done with its rate hiking campaign. Chip stocks gained on Monday, with one of their companies gaining 8%. A business survey showed that Japan's service activity expanded at the slowest pace this year in October, raising concerns about ongoing softening of the key sectors driving economic growth. They got to start raising their rates. And Tesla got upgraded. It's up 2%, which is great. Bank of America climbed a little bit. But mostly today, we're going to be trading on technicals. Now, let's talk about technicals, and this is pretty important. So right now, we're at the 50-day moving average. We're below the 100-day moving average. We know that this driver is going to be responsible for about 70% of all movement in the stock, so we got to be really careful. We're above the channel here. But again, so first, let me tell you what we've got going for us. And then I'll tell you what we've got going against us, okay? So let's talk about the bulls. What did the bulls have going on their side? Well, broke the downtrend. We broke the downtrend. That's very, very bullish. We've had very heavy momentum on reasonable volume, all right? And we have seasonality. So technically, we're not looking that bad. I mean, I don't like the fact that we closed near the bottom, not the top. You could see right here, we didn't really close right here. It was the top, 436. We closed near 435, but it didn't do bad. But we're still near the 50-day moving average. We need to go above that and break this level right here. Here, let me show you. We need to break above this level right here. There's a lot of resistance here, and you have the 100 days, so you've got a lot of overhead. So just to repeat myself, to the bullish side, We broke the downtrend, or at least the first downtrend, the channel. We broke the channel, downtrend channel. We've got heavy momentum, reasonably good volume, and we have seasonality. Now, what do we have to the downside? Well, we've got a lot of resistance here. We've got the 100-day moving average, and we have this area here at 437.50 or so. We've got too much momentum in the short term. We've had two gaps. Look at that. One gap, two gap. Doesn't happen very often. You'll have one gap, but to have two gaps in a row in the S&P, looks like we may have a pullback before going higher. FANG stocks are lagging behind. A lot of the FANG stocks are not making 52-week highs. So big cap earnings are behind us. That's another thing. And economy is still not doing amazingly well, okay? So again, I gave you the bulls, I gave you the case for the bulls, and I gave you the case for the bears. Now, I'm going to go with the trend, but I'm going to be very cautious that about this area. If we don't break this area, we're going to be in a bunch of doo-doo, and we're going to be coming back down. So again, remember, algos tend to overshoot a little bit, and this is algo-driven, very much algo-driven. A lot of this is short covering ahead of the FOMC last week. So again, we have to watch today very, 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 very carefully before we make any moves, because we can get suckered in here and then we could be losing this whole thing. So again, seasonality in our favor, price action in our favor, volume in our favor, momentum in our favor. But again, you got a lot of resistance here, too much too fast. Earnings for large caps are behind us. There might not be enough juice to continue moving higher. And we don't have a lot of Fed data this week, which may give the market a time to turn off. The major thing we have is seasonality is in our corner. That's big, big, big. As far as sectors, well, you could see here that sectors just ran away. But again, look at the QQQ. We're near this area, the 372-ish area. There's a lot of resistance here. Can we break through? Financials, can we break through this area? S&P, can we break through this area? Energies, well, let me show you something on energies. I like how we're bottoming out right here. Let me actually go to XLY here, XLE here. Still too early in the morning. I like the support. I like how we're bouncing off the 200-day moving average. So I think energies are going to be coming back up to a good level. As far as sectors are concerned, we got to be careful. This is not typical trading action, and it could turn on a dime. So I want to get a little bit of a momentum going. Most likely scenario, we're going to start cooling off a little bit and maybe filling the gap, and then we want to see if we have more momentum. I would be very surprised to see strong upside out of the gate. I would say that investors right now want the market to show its hand. I think institutional traders are going to be very nervous, because if we go long here and it's a false breakout, the downside is dangerous. And if we start breaking up here, then more shorts are going to cover. There's still a lot of shorts holding on. So I think the market's going to hover around here and maybe cool off a little bit, maybe fill one or two of these gaps, maybe go to the 426-ish level, maybe even the 200-day moving average, and then possibly come up. I like this move. I think this move has some legs, but I don't know if we're going to be able to go through all of that again. So I wanted to lay it all out for you, explain exactly what's going on. And again, please don't take my VIP room trades blindly. Pay attention to what I say, because I did tell you right here, it was the last telegram I had the Friday before last, that we're right here at the bottom of the channel, and there's a good chance we're going to come up. Now, folks, do you want to trade like a hedge fund pro? Seriously. And avoid making mistakes that you've made over and over and over again? Then you've got to see my Pro Trader dashboard. We've taken what I've been teaching for years and put it together in one place in over 3,000 lines of code. All you've got to do is copy and paste a link into Thinkorswim, and you're off to the races. It's that simple. Price action, relative strength, volume, simple common sense. No monkey business. It's all there for you. Cut out the noise. The fancy but useless indicators you've been using. Focus on what really matters for people trading on a day-to-day basis. Last week, I think we hit 11 or 12 in a row in the day trading room. We've been doing pretty well there. And the swing trades, they were doing really well till we hit this little thing right here. People were doing great on the shorts, but folks decided to really leverage into their shorts here instead of loosening up. Weren't paying attention to what I was saying. Cut out the noise. Cut out the fancy indicators. You won't get better edge in the market than this. I really mean that. And I'm not asking you to believe me. I'm asking you, you could see for yourself. Just look at the results. All you've got to do is listen, pay attention, and you'll see. Click on the link below for more information and start trading like a pro right now. I'll talk to you guys later. Have a great day. And it's going to be a great session today at 1 p.m. I can't wait. I've got 8 pages just for today's session. Bye, guys.